Well, hi, I'm James Traub with NEXA Mortgage. Do you think a non-warrantable condo means the deal is dead? Well, think again. Today, we're clearing up one of the biggest misconceptions in condo financing. Joining me is Frank Pena. He's the Senior Business Development Manager with A&D Mortgage to explain what realtors and homebuyers need to know about warrantable and non-warrantable condos. Hi, Frank. Welcome. Thanks for joining me.
Thank you, James. Condo financing can be intimidating, but once realtors understand the basics, it opens up to more opportunities for their clients.
So let's start with the basics. What is a warrantable condominium?
So basically, a warrantable condo is a condominium project that meets the guidelines established by agencies like Fannie Mae and Freddie Mac. These projects generally meet standards regarding like owner occupancy, HOA financial stability, insurance coverage, reserves funding, litigation exposures, and commercial space limitations. Because they meet agency guidelines, financing is often more straightforward.
Well, what makes a condo non-warrantable?
So basically, a non-warrantable condo simply means the project doesn't meet one or more agency requirements. Common examples would include like high investor concentration, pending litigations, inadequate HOA reserves, excessive commercial space, delinquent HOA dues, single owner concentration. And some of the red flags can include like large numbers of rental units, mixed-use development, ongoing HOA litigations, deferred maintenance issues, and limited reserves funding. Importantly, non-warrantable does not automatically mean it's a bad property.
Well, I think I've heard realtors say that the biggest one is higher investor concentration. I think I've heard that. So why should realtors be familiar with these distinctions?
Because financing can become a major issue after a property is already under contract. Realtors who understand the condo eligibility can avoid surprises, better advise their clients, save transactions, expand on financing options, identify potential issues early. Knowledge often leads to smoother closings.
Well, many realtors hear a lender say a condo isn't financeable. How does A&D Mortgage help buyers who are purchasing non-warrantable condos?
So Indie Mortgage specializes in alternative financing solutions. So our programs are designed to address situations that may fall outside of traditional agency guidelines. Instead of immediately declining a file, we'll review the entire scenario to determine whether financing may still be possible. In many cases, we can provide preliminary feedback very quickly once we have the project information. That early review can save realtors and buyers significant time, money, and frustration.
One concern realtors often have is timing. How does A&D Mortgage help keep these transactions moving?
So our team understands condo financing and reviews these files every day because we know what documentation is needed up front. We can identify potential issues early and work proactively with brokers. And communication and the preparation are key for these factors.
Yeah, communication is key. I recently had a conversation just a couple days ago with the realtor who added a phrase in the listing notes that the condo that was not HRAP, DELRAP, it was um, eligible for spot approval. So who are the typical buyers using non-warrantable condo financing?
So common examples will be just primary residence buyers, second home purchasers, investors, self-employed borrowers, and a lot of foreign national buyers in some cases. So the key is matching the borrower with the appropriate financing solution.
Well, if a realtor suspects that a condo may be non-warrantable, what information should they collect?
So some of the helpful items I would say would be an HOA contact information and condo questionnaire, HOA budget, insurance documentation, reserve studies, and litigation disclosures. Gathering all these information early can save valuable time later.
Well, can you share an example of a transaction that looked difficult but ultimately closed successfully?
Yes, of course. We recently worked with a buyer purchasing a condo that had a high investor concentration. Traditional financing wasn't available, but after reviewing the project and borrower profile, we were able to provide an alternative solution to close the transaction successfully. The buyer obtained the property they wanted, and the realtor preserved the transaction.
That's a great story. If you could give realtors one piece of advice regarding condo financing, what would it be?
I would say don't wait until financing becomes a problem. If you have questions about a condo project, involve your mortgage partner early. Early review often creates more options and fewer surprises.
Yes, it does. Today's biggest takeaway is that non-warrantable doesn't necessarily mean non-financeable. And understanding the difference between warrantable, non-warrantable condos can help realtors avoid surprises, expand financing options for their clients, and save transactions that might otherwise be lost. Working with lenders who understand condo financing can make a significant difference. So if you're a realtor working with condo buyers, or if you've encountered a project that has financing challenges, let's have a conversation before assuming the transaction can't be done. There may be financing solutions available that can help keep the deal moving forward. My name is James Traub, NEXA Mortgage, area code 317-407-8085. And Frank, thank you for joining us today.
Thank you, James. I appreciate the opportunity and thank you to everybody watching.